Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Letter and Banking on Profits, coming to you once again from Central Florida on a nice sunny weekend down here. The ECB delivered with their negative interest rate move this week and some other programs designed to encourage lending and get the old world off the dime when it comes to a very weak economic recovery over there. So markets were pretty happy about that. We had a nice 1% rally in the S&P 500, a little more than 1%. And some of the battered stocks in the NASDAQ recovered nicely, with that index rising about 2% on the week. Had some decent looking economic numbers during the week, positive ISM report. Auto sales are just absolutely on fire as we've bought back fog of mirror financing, and pretty much everybody's running out to buy a new car this year. So that's good news for folks in the auto industry. And of course, on Friday, we had the non farm payrolls report, and everybody made kind of a big deal about the fact that, hey, we've recovered all the jobs we lost in the Great Recession, and we're back to where we were in 2008. Yeah, except not really. You forgot to adjust those numbers for the population increase, folks. Matter of fact is to have the same unemployment rate, same percentage of folks working of the population as there was back in 2008. We have to create about another 7 million jobs, or almost twice as many as we've created in the last 5 years. We got a long way to go. Also, as an article in the Weekend Wall Street Journal pointed out, we're still creating an awful lot of low paying jobs, with most of the job creation happening in retail, restaurants, accommodations, bartenders, waitresses, the low end of the healthcare industry, and we're not seeing as much in the higher paying professions, manufacturing, construction, government employees. All of those categories are still very, very weak. So it's better than it was, but it's still not a good economy. So if you're kind of rushing in to buy stocks because you think we're going to have this great economic recovery, you might want to sit back, have an extra cup of coffee, and think about that for a little while. Anyway, first weekend of June down here, that means hurricane season is upon us, and we're going to be doing all the hurricane prep down here today. My son and I will get out there and we'll annoy the neighbors for a good period of time by running all the old gas out of the generator, um, checking the windows, the roof, making sure that there's enough water if it comes to that, extra tanks of propane in case we actually end up having to cook on the grill for a couple days. Now, Central Florida is not a hotbed for hurricane activity, but every few years one manages to make it here with enough strength to make things interesting around the neighborhood. So we're going to make sure that we're ready for that today. And the way we do that is we just ask ourselves, what could go wrong? And if we lose electricity, we've got a generator. If the water goes out, well, we've got plenty of water to get through for several days. So, and that's pretty much how people should approach the stock market too. When you sit down, instead of asking yourself, how much money can I make with this wonderful opportunity? The first question you really should be asking yourself is, how much money can I lose if things go drastically wrong? Now, when a hurricane's approaching Florida, we know all about it. We get the warnings, and they send us the little, hurricane tracking maps from NOAA. So you've got a few days advance notice to make sure that everything's ready for the big storm. And it's like that with the market too, somewhat. I think, right now, if you look out there, you've got guys like Seth Klarman, Sam Zell, and others warning us that, hey, things are a little pricey. Ned Davis had a report out a few weeks ago, said that the price to sales ratio of the S&P 500 is the highest it's ever been. And generally, when it's in that overvalued level, looking out 5 years, the market posts on average a negative rate of return. So, you know what? We've got the hurricane warning maps. We know things are a little frothy out there, as David Rubenstein of Carlisle put it. So it's time to be a little extra cautious and ask yourself, what can go wrong with this wonderful investment opportunity? We always try to solve that problem by sticking absolutely to our valuation guidelines and only buying cheap stocks. Take that a little bit further, though, and we insist on a margin of safety. We want that discount from asset value. So in theory, at least, the company could be liquidated at a profit. And then we want to look for an extra margin of safety in the balance sheets. We want a high current ratio, a low debt to equity ratio. Has to pass our 15-point credit and fundamental check with a score of at least 8. In addition to being cheap, it's got to be safe before it goes in the portfolio. We always ask first, what can possibly go wrong with this wonderful investment opportunity. If it passes the test, we'll buy it. If it doesn't, we won't. It keeps us out of a lot of trouble no matter what the market does. We know that we have this huge margin of safety, and if stuff's going down, we're pretty comfortable buying more. And of course, if it's going up, we're absolutely delighted by that too. We want to keep ourselves in something of a win-win situation when it comes to putting our cash at risk. Now, there was one really interesting article to me in the Wall Street Journal this weekend, and talked to a fund manager named Bally Gifford from the Scottish Mortgage Fund over there in Edinburgh. Now, he talked about the dangers of short-termism in the stock market, that most people are managing their portfolios on a very short-term basis, and this actually tends to influence the thinking of the folks running the corporations. He pointed out that it was short-term thinking and trying to hit those quarterly growth targets that actually encouraged banks pre-credit crisis to lever up their balance sheets and take risks that probably didn't make a lot of sense just to hit that magic number. And he warns, he tells investors point blank, you need to be hanging on to stocks a lot longer than you are. Now, he's a growth stock guy, so he picks stocks a lot differently than I do. We have one trait in common. We both kind of have that private equity mindset, and we're willing to hold stocks for a long period of time. In fact, his average holding period, now, most mutual funds hold stocks for somewhere between 12 and 18 months on average. His average is 10 years. He has one stock in his portfolio, a Swedish company called Atlas Copco. He's owned it for 25 years. Now, does it work? Yep, sure does. And the two funds that he manages, the Scottish Mortgage Fund, and he manages a international growth fund for Vanguard, he's beating the market by a rather substantial margin over time. In fact, by about 50%, just by holding stocks for a very long period of time and let the natural progression of the economy and these world-beating companies lead to higher returns. We do it with value by holding companies that are cheap and safe enough to survive until they thrive and recover all of their asset value. And hopefully over time that asset value is going up as well. Now, our holding period in our portfolios is until it works generally, or something goes drastically wrong and we throw it out because the fundamentals have worsened. If those fundamentals haven't changed and it still passes, we hold it until it becomes fairly valued, whether that takes 3 months, 3 years, or 7 years. You need to extend your holding period. This thing of trying to trade in and out of stocks on a short-term basis, trading into the quarterly earnings report number and looking for quick, fast gains is one of the biggest reasons that individual investors badly underperform the market. As Hunter Thompson used to say, you got to buy the ticket, take the ride, hold on to those stocks for a long period of time and let the magic of compounding work for you. Now, the markets are frothy. We know that. But if we take that long-term point of view, let's look at a decade. There are some pockets of opportunity out there. We have seen several situations pop up in the energy field, especially in North American related oil and gas companies and the fracking companies and that sort of thing. It's very out of favor business right now. We're awash in gas, and many of them are priced like demand for oil and gas is not going to go up over the next decade, and that's just insane. Eventually this economy gets back on track. People are having babies every day all over the world, so the demand for oil and gas is going to go up, particularly natural gas. I think you're going to see a move towards natural gas here in the US, and we will probably be more aggressive about exporting natural gas sometime over the next decade. So again, looking out over 10 years, are conditions going to get better at some point for the natural gas related energy companies? The answer is yes. Many of them are trading at 50 and 60% of tangible book value and are just outright bargains in here. We also have silver and gold miners are all trading at just fractions of tangible book value, and they have decent balance sheets. They have the financial wherewithal to survive until they thrive. And is there anybody out there that really thinks that at some point over the next 10 years, we won't see a stronger economy, increased demand for precious metals, or we'll have some type of financial and monetary crisis that sends the gold bugs crazy and the price of the metals soaring? There's no way one of those two scenarios does not play out over the next 10 years, in my opinion, which means these things are just a screaming bargain, and you should be able to get a return of several times your initial investment and not just a few percentage points. Small banks, of course, we see lots of opportunity there. I am absolutely baffled that everybody is not doing this. The table is set. It's ready to run. The money's there waiting for you to come over and pick it up. Buying financially sound institutions at 80% of tangible book value and just holding on to them until earnings completely recover and they become dominant in their local marketplace, Or the more likely scenario, they get taken over at a premium by a larger bank. I don't understand why everybody's not doing this. We started our banking on profits portfolio a year ago. We just had our fourth takeover this past week when TF Financial got bought by Penn National, and our four takeovers have averaged a gain north of 40% so far. It's free money. It's sitting there. It doesn't really matter what the stock market does. These things will be a lot higher 5 to 10 years from now. I have no idea why everybody is not buying these things. And of course, we also big believers in the Greek banks. Looking out over 10 years, Greece should recover. I don't think the Eurozone will let it go down. Things may not ever be fantastic there. It's not going to be a world emerging market growth leader or anything like that. But if it just gets back to stability, these banks should be 4 or 5 times higher. I promise you that all the people like Seth Klarman and John Paulson and Wilbur Ross and Prem Watsa and David Einhorn and others that have put their money into these banks during the recent recapitalizations did not do so looking to make 10-15% over the next year. They did it to make 5 to 10 times their money over the next 5 to 10 years. So we've gotten our money in right along aside of them. We really think that's going to be a fantastic trade over the next decade. It's been a pretty quiet week around here. We've got about another month until we have to endure another short-term silly season, known as earnings season, when everything gets pretty stupid and stays that way for about 4 weeks as everybody tries to make guesses about the guesses of the analysts on earnings reports. So not a lot going on the corporate news front. Been a very slow week sports-wise. My Orioles, playing 500 ball again, just not getting it done. Got a game against Oakland today. Oakland's been a superior team so far this year. They've only lost 2 of 10 road series this year, which is pretty impressive. Now, so far the Orioles have split with them, and we have a chance to give them their 3rd road series loss. That game starts here in a little while. Hopefully we'll catch part of it after we're done annoying the neighbors with the generator. Then we've got the Red Sox coming into town up in Baltimore. I'm sure my daughter and her fiance live right down the street from the stadium. They'll get to a few of those. And then we've got the Blue Jays to finish up the week. Next week, they come down here to Tampa. And instead of an airplane ride, I can just drive over for about an hour and probably catch a game or 2 this week. So that should be fun. Very quiet book week. I guess the publishers are giving us a chance to catch up on the madness of the past few weeks. Just finishing up Jeff Girard's Smoke at Dawn, his latest Civil War novel. If you like those type of books, if you've ever read any of his from his father's Killer Angels on forward, they're great reads, fantastic summertime reads. Just about done with it. Highly recommend it. Now, as I was looking through the book world earlier this morning, I looked through the new releases for investing books, and boy, there's just not much coming out. Everything's trading oriented, and how to trade options and how to trade Forex and how to make $1 million in the next 52 seconds, and just ridiculous titles from my point of view. Not really anything interesting in the investing book world coming out until September, when Guy Spears' Education of a Value Investor. I'm really looking forward to that one. That one should hit the shelves. If you're looking to broaden your investment knowledge, gain some insights on the market, you might want to go back to 2 releases from the past year. Tobias Carlyle and Wesley Gray's Quantitative Value is a fantastic read on the markets, and Victor Wendell's Net Current Asset Approach to Investing is one of the better value investing books to come down the pike in several years. So rather than buying the new books on how to get rich in the next 3.5 seconds without risking a dime, I would suggest those 2 would add a little bit more to your investing education than some of the garbage they're bringing out recently. Anyway, not much of a busy week here in the U.S. We do have the Chinese numbers coming out, so we'll get to see exactly what the Chinese government wants us to believe is going on in that nation. Most of what I've read says that they're going to release some pretty positive numbers. Everybody thinks they'll come in above consensus, and how everybody can think it's above consensus is baffling to me, but that's what the paper said this morning. But we'll see. You just never know what China's going to release. They may decide they want prices down around the world, and they'll bring us some bad numbers. Who knows? But that will be a market mover. Those numbers all come out, I believe, on Tuesday. That could create a little volatility in the market, so be prepared. And the World Cup starts this week in Brazil. Now, unfortunately, for those of us here in the United States, the games are going to be played primarily in the Central Time Zone. So, unlike the years when it's played in Europe, we do not have a valid excuse for drinking beer at 7:30 in the morning this year. You'll actually be able to catch the games around happy hour at normal hours. So, bartenders and bar owners around the world are a little disappointed by that because that was some bang up business the last World Cup with all those fools down at the bar at 7:30 and 8 o'clock in the morning cheering on their favorite World Cup team. I probably will not watch a minute of it beyond what I see on the highlights, but let's hope the U.S. has a good showing and that Goldman Sachs is wrong and Brazil does not, in fact, win, just because we hate it when Goldman Sachs is right. Anyway, that's pretty much all we've got here. I've got to go do a little hurricane preparation and get ready for the hurricane season. And then I'm going to try to kick back, relax, and watch the Orioles take care of the Oakland A's. Have a great week, everybody.